So, good evening, everybody in India, and good day to you if you have joined from other parts of the world. Uh, it is 8 p.m., and we will start the next edition of Rupee to Sampatti. And as you can see, the topic for today is that is the global recession coming? Now, the word coming, some of you might say, oh, what are you saying coming? It's already here. But you should remember that this is the topic and our esteemed speaker that we selected a month ago. Because we have our webinars on the last Thursday of every month from 8 p.m. onwards. And Dr. Srishti was really kind enough to, hunt and find the world's best expert on this topic. So I introduce to you Dr. Srishti Jain. She is a certified financier, and I know her because she is an intensivist. And her intensive action is not only in saving lives in the hospital, but also in going in depth to identify what is it that will allow us to create wealth as an individual. So, without wasting much time, I hand over to Dr. Srishti, whom I call the Queen of Wealth Creation. Over to you, Srishti.
Thank you so much, Dr. Purvesh, for your kind introduction. Ladies and gentlemen, for tonight, we have our esteemed guest, Mr. Henrik Zeberg, with us. Henrik was very kind to agree to join for our webinar. He's on holiday right now in Spain. Let me take the pleasure of introducing Henrik to all of you. Henrik is based in Copenhagen, Denmark. He's a macroeconomist, bank advisor, long-term Elliott Wave chartist. He's a distinguished macroeconomic expert based in Copenhagen. He currently serves as the head macroeconomist at Swiss Block AG, a leading wealth management firm, and is founder of the Zeberg Report, where he offers in-depth analysis and insights on macroeconomic trends and market dynamics. With a robust background in business cycles and Elliott Wave analysis, Henrik is recognized for his audacious predictions regarding asset prices. He integrates historical economic indicators with contemporary fiscal policies to deliver actionable insights for investors. Known for his contrarian perspective, Henrik maintained a bullish outlook during late 2022 when many analysts were bearish. His confidence in the cyclical nature of the market positions him as a thorough leader in macroeconomic discourse. Join us in welcoming Henrik to our upcoming webinar, which is today, where he will share his expert insights on navigating today's economic landscapes. I'll hand over the mic to you, Henrik, and I'll request all of us to mute ourselves. Welcome, Henrik. Thank you so much.
Thank you very much for having me on today. It's a pleasure to be here, and it's a vacation here in Spain, but it's also a workcation. So I actually do a lot of work. So I'm happy to be here and to present this. And yes, I will jump into a presentation here to try to answer whether a global recession is coming. And thanks for the kind words on my previous the calls. So now let me jump into it. I will maybe speed talk a little, and then you can ask the questions in the chat, I think, and then we'll take those up. So let's hit it on. Let me just share here for a second, and then I get to it. There we go. I hope you will be able to see my screen now. Let's see if. Do you see the screen? Can I just
not yet.
On that? Not yet.
Not yet.
Okay, we have it. Let's see. Now I think you should. Yes.
Now it's okay. Yes, perfect.
Yeah. Perfect.
Good. And let me just do the full screen here. So, why a recession is already in the cards is what I'm calling this presentation here. And I will speed talk through it. And again, as we just talked about here, also with you, why is it that when we look at indications of a disease like new with doctors, also you look at different symptoms, and then you'll say, are we what is the actually that this person is what is wrong with this particular person, or what is the illness? And that is also the way you should go about looking at an economy. There's never one sign or one thing that is telling you everything. And again, there will be, it's about taking the full picture of it. And that's what I'm trying to supply you here. And that's why I'll be speed talking. I don't want to say much about myself. You already did introduce myself. I want to say that, yes, it's all the thing I do is based on what is called the business cycle model that I've developed, which is the backbone of investing. If you understand big, I think it's Ray Dalio also who talks about you need to understand the business cycle in order to do proper investment and or to set your investment correctly. And I think that is what I've been taking in also. It's about learning from some of the best. And developing that was really a turning point also in how I go to markets, and then using the what I call a multi-dimensional economic model and based on Elliott wave theory, which is not something a lot of people like, but that's what I do it and how I do it. And then I am the head macroeconomist at Swissblock, and you can go and take a look at that at Swissblock Technologies here. It's a private wealth manager. Don't want to talk a lot about that. But wanted to just jump into my core methodology of how do I do this very quickly, so you understand again how I go about things. First of all, there are always this schism between the fundamental analysis and the technical analysis, and I look at the markets in a technical way because I think that is where you get all the information from every aspects of a dimension of the market, because in the price of a particular asset, you will always see all the available information. So when people are talking to me about, but Henrik, what about this particular factor here? Then I'll say, well, that's one factor out of the thousands or hundreds of factors explaining a particular asset price. And you can never say, I mean, it would be kind of arrogant to think that I can find the most important factor and think that that is the why, things should go in the direction I see. That is why I think technical analysis is stronger than fundamental analysis in doing market analysis. Again, there will be people that are very good at doing fundamental analysis and do that very and prosper from that. And there will be people that do technical analysis very wrongly and hence not do as well. My approach is the pattern recognition and the technical analysis. And then there's the thing about deductive and inductive way of reasoning. So when you look at a problem and you say, okay, what is it that I see? How do I actually conclude something which is the most logical conclusion? I use when you have the economy, you never get, this is the one thing that tells you that the economy is heading in a certain direction. So you need to look at all the indicators that you have out there and then look at it with agnostic eyes and say, what is the most probable conclusion based on what I'm looking at, and not jumping to conclusion based on one or two of them, but actually entire picture. So when people come to me and say, Henrik, what level in the S&P do you need to see broken in order for you to see that your thesis is wrong? Then I'm saying, well, it's not about one level in the S&P. It's about the totality of the picture, the extreme amount of variables that we have out there. Let me just get some water. I always get very dry when I talk, so please allow me. So I use the hypothesis base my hypothesis on a long range of observation and facts, and then I derive the most probable conclusion on that. And I want to give you some insights into that today. And then I use the Elliott wave analysis, which is something where we have to understand that even though we are feeling, we make decisions on a daily basis, and we say that we are not part of a group. We are actually subject to a lot of input from the world around us. And that means that even though we feel that we make conscious decisions, we are very much a part of a lemming group. We will, the crowd dynamics is there, and it's very powerful. And actually, when it comes to crowd dynamics, you can actually understand things much better. You can make simulations on if a fire breaks out in a building, pretty much how people react depending on where they are on different floors and so on. That is the same with the market. And we go through the same kind of cyclical behavior in our minds, in our sentiments, in terms of becoming over optimistic, over pessimistic. And if you pull that up in a lot of people being exposed to the same kind of news coming into the media and so on, well, then we will act like a group, and there will be some outliers. Some people will see things before, but in the larger group will move like a big organism and according to these crowd dynamics. And this is actually where psychology is playing into it as well. And this is what Elliott wave is taking in. So my approach is based on this pattern repetition, use of the sentiment and inter-asset, inter-market calibration, which is how I do my things, and using an inductive way of reasoning. And if you look at the calls I've had, have I been wrong and have been right on everything? No, I have not. That's because I'm trying to calibrate my model, but these are some of the calls that I've made over the years, especially after I got my business cycle model all in place. And there are some of them that are more controversial than others. Let's see after today how controversial some of these are that I'll be coming out with to you guys. But what is right here at the bottom of it is call of a major recession. Excuse me. By the end of 24, and we're closing in on that. So my timeline is here is very close, but it could also be that it's starting in 25, it's early 25. I have to say early 25, and then into 25 and 26. And obviously that call is pending, and it's one that is contested by a lot of people that are analysts and everybody who thinks that we have a soft landing or a no landing or whatever they call it today. I say we have a major recession coming to us, and it's going to set in very soon, unfortunately, because it's going to bring a lot of bad things to us. And again, I don't want to jump into these all the credentials here, but just to say, so my thesis for now is that we're going to see a blow off top in the U.S. indices into Q4 2024. This is from a presentation I did earlier this year. And it means that crypto and risk assets should soar into new highs. That was before we saw a new high on the S&P, and I still stick to that. We will still see new highs in S&Ps and also in NASDAQ. And we should also develop an extreme euphoria, especially in the US markets. I think that is where we're going to see it. I think we're going to see a global bear market to set in Q4 24. And I actually think I can show you some things today that seems to suggest that it's actually starting already in Asia and very soon also in Europe. And I think the recession is going to set in, as I said, Q4, maybe Q1 25, but Q4 24 here could also be the situation. And that we will see the dollar soaring, we will see plummeting market yields, and we will see that the Fed coming into 25 actually reacting in a way which will create a market bounce, but it will actually offset a stagflation, which is a much worse thing than what we see with deflation. And we're going to see a gold, silver, and precious metal bottle, and they will soar with silver and gold miners, and we'll see a whole new commodity bull being born at that time. So these are a top-down way of looking at what are the main theses here. And now I want to dive into why is it that I think a recession is coming, and why is it going to be deflationary first, and what will it mean in terms of the market for the markets and for equities and so on. So, but right now we have to ask ourselves, and maybe some of you will be thinking, recession, what is he thinking about? How, what hasn't he been reading and been looking into the papers and to the analysts and to listening to the Fed? And what about this with the soft landing? And what is that, by the way? So if you think by yourself, how many of you would actually think that we have a soft landing? Just, think about that. And let's go through the amount of evidence that I have, or the indications that I have for what I think is ahead, which is something quite different, which is a recession. And if you look back to 2007, 2008, we actually saw that we had the Fed, Bernanke, and so on, all of them in early 2007, and sorry, late 2007, early 2008, were calling for, okay, we have a little troubles upon times, but it's not going to be troubling times. It's not going to be a recession. We're going to see not a big challenge. And actually, even into just a month before we had the meeting of the Federal Open Market Committee down here, we saw that, they said that we are going to have a soft landing. They said that 1 month before the recession set in the US. So interesting to see that was something they said before. And when we see that today, again, we see Fed Chair Powell sees a good path toward an economic soft landing, and we hear soft landing all over the place. So obviously I must be wrong because I'm in the different camp. We're here. We have some of the news from this year. Again, I don't think it's about being the same side of the boat like everybody else. I think it's about looking at the facts. And this is, I'm from the country of the Hans Christian Andersen, and this about the little boy pointing to the emperor, and there might be a lot of important guys around you saying that this is very nice clothes that he's wearing. Actually, I like to say, well, is he actually wearing anything? And that's the same with the economy. Are we seeing the economy wearing anything, or is this just a mirage? And people being, if you do not understand that there is a soft landing, then there's something wrong with you. It's because you misunderstand things and you're not good at your job. So what was it actually we observed in the macroeconomic indicators in 2007 and 2008 before the recession? And what do we observe today? That is a fair thing to ask ourselves. So first of all, I want to introduce the business cycle model and the business cycle. And it's The business cycle is something a lot of people use in various ways, and there are some that uses PMI numbers for that. Actually, I use the conference board, and this is something I built together in Swissblock in my current position with the business cycle model, which has 4 phases. When you are above average, long-term trend, and we're expanding, we see an expansion phase. Then we have a slowdown phase, we have a contraction phase, and we have a recovery phase. These are the 4 phases of the economy. And currently, we are with the leading indicators, which is one of the indicators. I'll get back to it. We are way, way, way into red territory. Just only comparable to what we saw before 2008, 2007, where we saw the leading indicators leading us into a big red signal saying something is wrong. The leading indicators, I don't want to get too much into that today because we have limited time, but then we have the coincident indicators, which is the real economy. That's the employment numbers, that is production levels and so on. And then we have the lagging indicators, which is inflation, which is rates. So this is what I think is also the misunderstanding when you see people out there not understanding business cycle, is that inflation is not something that is front-running the economy. It's actually something that is lagging behind the economy. So when the economy rolls over, you'll see inflation rolling over. And that's why it's important to look at leading indicators. And some of them we have up here. We have the leading indicators here. Then looking at the coincident indicators for whatever comes in the leading indicators, we should see coming in the indicators of the coincident indicators. And then we should see it in the lagging indicators. This is the business cycle. This is how it needs to be understood. And this is how I understand and been using it. And using this model, we have never seen a false recession signal in the leading indicators for the 75, 80 years. We can go back in time. It has always been correct. So it's not a timing signal, but it's a signal saying that when this flashes, you're going to have a recession eventually. The economy is going to roll over. The coincident indicators being the labor market and so on is going to deteriorate, and you're going to see a recession. That is what we saw back here early 23. We saw the signal coming in leading indicators. The red line here moved down, just like what we saw in 2006 here in the financial crisis. I apologize for the picture here. This is the best I just could get here, but anyway, we can of course go back in time and see all of these data here. But it had a crossover here and went down a lot, and we are seeing that same thing today. Please notice it also got the Corona crisis. We also had an indicator there. And we see then how it actually leads the coincident indicators into getting a rollover of that. And that is actually when the recession sets in. We are not here yet. And the coincident indicators then lead the lagging indicators into seeing, as I said, inflation and rates and so on should then be following. Because again, inflation follows what happens in the real economy, not vice versa. And this is again where a lot of people gets it wrong, as I said. So this is the backbone, as I said, the business cycle model of my thesis and of the way I do my work. And we have a signal in place from 2023, which is still there. And we still see the leading indicators are deteriorating. And we saw that just the other day coming out, still declining, which is not a good signal. That's a good thing. So the business cycle's leading indicators, they actually warned us in 2007, 2008, when the Fed and macroeconomists were dismissing the idea of recession. They told us that, sorry, I think I just lagged there. They were actually telling us that we are going to see a recession. And today we see the same. We have the leading indicators and we have, raised hand. Is there something wrong here? Please let me know. Is there
all is good, Henrik.
Good?
You can continue.
All is good.
All good.
All right.
All
good.
Yeah,
excellent. Yeah. And then today we see the same. And so we have to say, at least the leading indicators told us that back then that things were wrong, and they have told us again and again and never been wrong. And then we see the Fed and all the analysts always being wrong about calling. When have you ever seen this Fed coming out and saying, hey, we actually get a recession now? Never. When do you actually see the bank analysts do that? Very, very rare. They went to see that. So that's why what I'm here. I'm the little boy in the emperor's new clothes and trying to just look at what we see. And that's what we want to dive into now today. And what is it then we see apart from what we have seen in the leading indicators? Actually, now I'm starting out with one of the kind of leading indicators, because the yield spread is one of the leading indicators. The yield spread is the difference between the 10 years and the 2 years. I don't want to get too much into it because I cannot explain all the indicators here. But if we start to look at that and see going back in time, By itself, it's not it is a very good indicator of that we are seeing what we're going to see. And every time we get a rollover of or we get a recession, sorry, we get a yield spread inversion, so the 2 years become higher than the 10-year, we get a recession at some point. And we can go back in time and look at that. There are a few indications where we don't see that. But again, here, if we go back and see before the financial crisis, we had it. It was not the inversion by itself, but it was when it moved back up again, the clock started to tick. Same here, and even into the corona, we had a small yield inversion. And now we actually have a yield inversion again. And we also have the uninversion of this again. And we remember that that is the time when we should start to look into and say, okay, now things are starting to deteriorate. And we have actually had the most massive and longest lasting yield inversion we have seen ever. So this is a major thing. And how you can just dismiss that and say, okay, we don't think about that any longer. And by the way, the Fed has all saved for us. When we see these massive yield inversions, something is wrong. And this is the indicator, just like what I said, with a doctor looking at things and saying, okay, this number here is just off. It's just completely off. There's something wrong. And it may be that the patient says, I'm fine, but it does not look good. This is not good. And we can just compare it and go back in time. First indication, first exhibit of evidence. And then people will say, yeah, Henrik, but that's just the 10-year minus the 2-year. But even if you go past and you go through the yield curve here, the 1, 2, 5, 10, and 30-year on the US yield curve, you will actually see that when we have a yield curve inversion across the different length of the durations here, you actually get a recession. The green areas here are the recessions. You get a recession. Here into what they call the soft landing in the 90s, we actually did not get a yield inversion across the table. But we did that here, and we got the recession. We got that here, we got that recession. And even here, it doesn't show the recession here. It's because of the indicator, the recession indicator, but there was a short recession here during Corona, as we all know, just 2 months. And even that was picked up by the yield inversion. And we now have a massive yield inversion here, as I said, even for the 2 and the 10-year, 2 minus 10-year minus the 2-year, we have the most massive one we've seen, and we see across the board here as well. So concluding here that this creates recessions every time we see it, but not this time, just sounds wrong. Why would I conclude that? I don't see that. Again, just a piece of evidence, not by itself a complete piece of evidence, but it's a puzzle to the big picture. And then if you look at the 2-year yields and what we have seen here, and you have to remember that if you look back in time here, and again, the green area here is the recession periods we have. And every time we get a business cycle recession signal, we have that here, 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 and here. And we start to see the plunging of the 2-year yields. And we see the RSIs rolling over. And we saw that here, 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 and here. We got the recession. See, there's, again here, when I look at this, and I compare it to what we have seen over here, it does not seem like there is not, I mean, yes, we've seen October here has been bouncing. Actually, October 2007 actually also was a bounce month for the 2-year yields. And even though we saw a recession setting in by December. So we have the recession signal. We now have a massive topping signal. And if you look at these momentum, which is RSI, this is actually something I use a lot, momentum, saying, okay, the economy is like a super tanker. If you start to turn the super tanker, it doesn't just turn like a speedboat again. So when we start to see the momentum putting in what is also called a negative divergence here into the top, that is a very big topping signal. And that is why I said for some time, rates are going to come down, yields are going to come down. Now they have moved down lower. Nothing moves in a straight line. And we see also we had bounces here, and we have bounces all the time when we see a directional move. I say we are now moving lower because that is what the business cycle also tells us, that we have an economy where the leading indicators tells us what is happening. Then the coincident indicator should be rolling over, and then we should see the lagging. It's not really rolling over yet. It's not declining. It's not crashing, but the trend and the momentum analysis tells me that that's at least what we could expect to see. And again, I'm just adding that to the puzzle. So if we look at that and just concluding based on the market yields, saying that in 2007 and 8, the yields told us that something was wrong because they started to decline very strongly, which we have seen again this time around. And then, so we need to put that into the puzzle and say, okay, what does that indicate? We're not, of course, we do not see the full thing yet. But like a weatherman, and you're forecasting the weather tomorrow, you do not actually get to see the weather before you do it. You actually have to say, what is the most probable thing you're going to see based on this? I say yields are going to plunge. And I think we're going to see a very strong development into December, January, February, and so on into early 25. So, but then everybody, of course, knows, let me just get some water, that of course it was because of the housing market in 2008. And that was the reason why we got a recession. Well, agreed to a certain degree, but it's actually because the yields made it impossible for people to actually sit with the kind of loans and the mortgages that they had. But agreed, there was a big bubble there. I'll just say we have an even bigger bubble now. But anyway, let's look at now what we see with the housing market. And here we look at the NAHB housing market index, which is all related to the housing market. And we see how when the when we have the housing market starts to decline, the NAHB starts to decline, we see some time passes by, and then we see the unemployment rate moves up. This is an inverted rate on the unemployment rate. Hence, when it moves down, it's actually moving up. So we saw that. And that's because when we know the business cycle, we know that when the yield starts to spike, people will then have harder times to actually, spend money on consumption and on their houses and all that. So that's why they will, will start first to cut that off. And then later on, when the yield spike has been going on for some time, they will start to cut down on other necessities, which are more of a necessity. And that's what we see every time. We see that with the NAHB starts to move down, and the stronger it moves down, the stronger the rise in the interest rates. Sorry, and the unemployment rate. So we see that the strong decline here in the NAHB takes some time. It took some time here, and we saw the decline, and the recession set in the green area. Same here. Then we had the corona, boom, 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 very volatile, but we had the top here. Now, we have seen the NAHB moving down like this. So the clock has clearly started. And we also have seen what seems to be a top in the unemployment rate. It's not crashing yet, but maybe that's because of all the stimulus that was sent out, and people have been saving up money for some time, which means that they are keeping up their the consumption for a certain amount of time. But at least we have another indicator here from the housing market telling us that this does not look anything like this when we are in a nice period of time. It looks more like what we have here or here, which caused a recession or even into corona. So another piece of the puzzle we put in and then say, what is that we look at? Housing, US house price index. Well, when we see large declines, we see recessions. Here we see existing home sales. It's not a house price, it's actually existing home sales. Sorry about that. It's because of the headline is wrong. So what we see here was a 41% decline. We saw a recession. Even when we see smaller declines, we see recessions also. But we don't need to see it if they are small enough. But when we see 40% declines in this, while we see the unemployment rate is moving up, well, I would say that chances are, again, on my side here, at least if I was a betting man, I would bet that this would not, a good outcome that I should be expecting when the existing home sales are moving down like that. Why does it do that? Because of the yield spike that we have seen, which is also what the business cycle model tells us. When yields are moving up, the economy slowly gets strangled by the interest payments that people have. And then if you look at the housing affordability index also, because, people saying it's not so bad this time. Well, actually, it's worse than it was before the financial crisis. Housing affordability here now is way below what we had in 2006 and 7. And we need to go back to the 80s, early 80s, which was a really bad time also in the US when it comes to housing, to understand what we see here. So why would I conclude now, again, the patient here we're looking at, that a soft landing is coming? Right now, the numbers here are low. That tells us that we are not seeing something good for the housing market. And we know how important it is for the consumer. You got your house, you got your job. And if your house is deteriorating in price, you start to feel a little, okay, that's not so good. And maybe we should cut back a little and so on. But if you lose your job on top of that, then it's really bad. Right now, we are seeing in one of these indicators telling us things are not great, guys. Let's look at something else. US building permits, also an indicator of the housing market. So every time we see that declining, we get a recession. And actually, we have a recession signal here, which I've developed. And we see every time it flashes, every time, even the small ones, we get a recession. We now have that flashing again as well. So why would we then say that? I don't know if you can actually see that, but why would you then we conclude now with the recession signal here crossing over, actually conclude, okay, the most probable outcome of this is soft landing. I don't see it. I'm just being the boy in the emperor's new clothes here. And if you look at the mortgage market index, so what is the demand for applications in terms of the new mortgages, which is a very important part of the economy, that people are actually lending money, credit, getting credit to buy a new house. It is through the floor here in terms of the mortgage applications. So it does not seem like the housing market is doing fantastically well here, as I see it. I find it difficult to see why people will conclude, oh, but the housing market is great. So I say it does not look too great right now. But then again, you may ask, why then should we experience more economic challenges? Could it just be that it was a soft patch and we're just going through? And by the way, we know inflation is down. The Fed and the majority of analysts tells us that we have a soft landing. Well, let's look deeper then. Let's look at the interest payments as this part of disposable income and understand how that actually affects people. And it affects me as well. I also have a mortgage loan. So if you look at the interest payments as percentage of disposable income, you see how it's moving up. And if you look at the rate of change, this has been the fastest move up higher that we have ever seen in going back to the 1950s. And at the same time, we see the debt on the balance credit cards, debt balance on credit cards and on auto loans have been skyrocketing. That doesn't sound good, that people are actually paying more and more on their interest on their debt. And what would that make, what would happen in an economy there? Well, I would think that the consumers would have to cut back on certain other necessities, or at least, starting to pull back. That would be my take from this. And what we actually see is that every time we see the interest rates interest payments moving up like that, the blue curve here, this actually caused the consumer to struggle because they have to pay more in interest rates. It's not the rocket science. And then we will see that they will spend less. At some point, we see the unemployment rate is moving down in the beginning, but at some point it starts to round. We see the bottoming of the unemployment rate. And because people are spending less and less, it actually starts to move up. That is how it's understood in the business cycle model. We see that every time. And the higher the spike in the interest payments, the stronger the spike in unemployment. I say this spike we've seen here is going to cause a lot of trouble. And it is right now because the consumer is not well, as I see it. Also looking at the retail sales, we had retail sales numbers last week, came out of 1.7% year on year. I can see I was just lacking there. Okay. That is not a great number. People say, yeah, but it's rising. Well, it's not a great number. It's not showing anything of an economy that is improving. It shows that we are not falling through the floor yet, and we're not, falling off the cliff. But it's not a great number, and we can only associate that with some bad times that we had in previous times here. Going into the recession here in 2007-8, we had a similar number like that. Why would we conclude here that things are great? Shouldn't they be moving up then? I say we're not there yet, and now you will hear me say that all the time. We're not in a recession yet. And even though it may feel hard time for some people, I would just say that is what is going to create the recession. It's not the recession by itself, because the recession by itself will create a lot of loss of jobs. So what I see here is not an economy that is strengthening. I see the opposite. Again, a piece of the puzzle, inductive way of thinking, putting into the puzzle and saying, are we actually seeing this moving up, or is the trend moving down? I see it move down. And let's see what the coming months are saying. Delinquency rates. So if you're looking at credit card delinquency rates, they are moving up. And at different levels here, you can take a look at that also and then say, what is that resembling most? Is that looking what we had after the period of the financial crisis, or does it look what we're going into the financial crisis? Why would I conclude with something like this, that the consumer is well? And we can see also that the debt levels were moving up as well, as I showed you just before, for auto loans and for credit cards. That is not a good thing. So it seems more like people are actually using their credit card and maxing them out to make sure that they can make ends meet, and not a soft landing. Because a soft landing to me would be that the cost of credit and the cost of interest, the interest payments were moving down. That's not what we see. We see the opposite, or actually they are staying high. So we see the number of credit card defaults, and I only got something from Q4 here, so Q1 in 2024. So we need to see new numbers here, but that does not look like something that is a good direction for the number of people where we see, the credit card defaults. It actually looks bad. It looks like people are struggling because of the high interest payments that we're seeing. That does not mean the recession is right here and right now, but it means that we are that the economy is deteriorating and the economy is holding back. And when they hold back, they don't ask for bank credit. And that's what we see every time also we fall into a recession. We see bank credits is topping out at some point, starting to move down, and then at some point we get the recession. Same here. Sometimes it takes longer, sometimes it takes shorter time, even into the Corona crisis. And I will say, no matter if we had Corona or not, there would have been a recession. I can tell you that. I don't want to discuss that today, but we would have had that. Then they stimulated like crazy and they got another bounce. But we see how the credit is rolling over. People are not requesting credit to the degree. Why? Because the interest rates are so high. So why would we think that this is a blossoming economy when the credit is rolling over? Credit is such a big part of the economy. And then we have David Rosenberg here saying also the cheerleaders are telling us that the economy is strong and in for a no landing, where we see the buying conditions for houses, the buying conditions for vehicles are just low, which is also what I've been saying. So I don't think the consumer looks well. And we have to understand consumption in the US economy is 70% of GDP. They are struggling. So why is it that we should conclude based on this that we have a soft landing? Difficult for me to see. But yet we have not seen the consumer having lost his or her job. And the UK businesses, well, the US businesses are okay. At least that's what we are told. We saw, nice earnings profits numbers coming out of Tesla and so on. And they're not cutting their workforce yet. That is a picture from the top of the chain. That is not what we look at if we look at the broader economic conditions for the US economy. The small businesses index, optimism index, is at levels we see in recessions. It's down. And it's down because of, again, the demand is not there. The consumption from people is not there. And we also see that if you look at small businesses funding rate, and this is from Game of Trades, I need to always make sure that we, of course, refer to the right people who made the charts. We see that this is not what a soft landing looks like. A US real prime rate and the business funding rate is up here, meaning that businesses are struggling to fund their whatever loans they're getting, whatever loans they need to have. Is that a sign of a thriving economy, an economy that should be moving higher? I don't think it is. And if you look at what has been happening and why it's taken so long for the economy to roll over, I think it's because we've seen a lot of businesses into Corona and after the stimulus coming out, which was massive. It was more in terms of day-to-day or likewise money than we saw after the Second World War in Europe when we had the Marshall Aid. Much bigger than that, and we had an economy that was not we didn't have to rebuild all of Europe at this time. So of course the businesses were expanding, and that's why we saw job openings per unemployed soaring, and that is building capacity in the businesses around the world. And of course, when you build capacity and then you wait for that demand to come, everybody was doing good business in 2021. Then you don't just, cut it off immediately. You wait and see, the demand will come back. Now we're ready for it. Actually, we've seen the number of job openings per unemployed declining now. And that's the first thing you will do as a business. You'll start to say, we don't need that extra engineer or that extra whatever before we start to slash people. That is what I see has been going on, and we are now down. And this is also why Powell says the job market is no longer red hot. What you also will do is that you will start to tell people in the manufacturing here, you don't need to work so many hours because we don't see that kind of demand yet. But be ready for it. We're not laying you off. What you see here is actually that we are seeing a decline in the aggregated number of hours worked, which is what we see also into recessions. So why would I conclude that the economy is well? Shouldn't we see the economy is then picking up and people should be working more and more, and the number of ads, going out and people's, being new job openings should be increasing? We see the opposite. And what we also see, and this is more technical, when we move in, this is industrial production, where we see this, that the bounce that we have had in industrial production here, and looking at that with my technical glasses and saying, we have negative divergence on the momentum, meaning that this is a very slow move up higher. I say we are about to see it fall out of bed, or fall out of the cliff. And when Powell talks about, I need to see actually that we get more deterioration, we can look at the deterioration in the labor market. It's already there. If you look at the Piper-Sandler recession indicator and you go back in time, you go into the 50s, every time it's flashed, it's been correct. When 3 months SMA rises above its level, 12 months earlier, from the levels from 12 months earlier, we get a recession signal. We have had that. Some time passes by, the recession sets in. Sometimes it takes longer, sometimes it takes shorter. But this time around, and I have to say, I'm not wearing a tinfoil hat. I think it's weird to see that we actually had in September 785,000 jobs created, or new jobs in the governmental sector in the US. You can go check that out. It was a very high number. It was 10 times higher than what we saw into any other month in September going back 20 years. So I think there are some, let's say, distortion in the numbers at this point, and I'm not wearing a tinfoil hat. I'm not political or anything like that. Also, if you look at the unemployment rate in my model here, every time we see the RSI, the momentum of it starting to move higher, we actually have a recession. We have that crossover. It has always led to a recession every time. And I say, well, let's see this time. And if you look at structural unemployment, meaning the number of weeks the people are unemployed, well, we see that starting to trend up. When this, first of all, is actually higher than any time any number we have seen going back in time. So ever since the financial crisis, things have not been so great, but now it's trending up again. And every time it trends up, the number of weak people are unemployed because the demand for new people coming into the labor market is not there. So people are staying unemployed. Well, it's actually moving up. And if you look at the initial claims, and this is the one canary in the coal mine, we need to see today they came out, they were 227. People were cheering. Oh, all is good. Actually, that is correct. For now, the canary is not moving down, and it's not dropping dead in the coal mine, but it's just a matter of time. Every time we see these rounding bottoms, as I see it, then we see the move higher. And we have a rounding bottom. We just need to see the acceleration. And we also need to look at not the difference or the expectation, but actually the number of continuous jobless claims. And if you look at that, that has actually been rising quite a lot since the bottom we had here. So again, I'm looking at all of these things here and saying, are we seeing that if you disregard Tesla and Apple and all these, but looking at corporate US, the real, and US, I have to say, even though India is a huge country and the biggest in the world now population-wise, and China and so on, it's about what happens in the US still. When the US catches a cold, the rest of us, get pneumonia. And that's why I see it. That's still how it is. So corporate US, the real businesses, the real ordinary person in the US is not thriving. And I see that the businesses are starting to adjust their capacities in terms of what they need in open positions. And I think that the cutting of jobs is going to come. Well, when will that happen? Well, I think it can happen all of a sudden. And if you look at the initial claims, we see how all of a sudden it just spikes. All of a sudden it just starts to spike. Sorry, this one actually. So it just starts to move higher and higher. All of a sudden, it just takes off, because then people can start to see, okay, and the managers see things are not good. So when we conclude soft landing with a inductive way of reasoning, and I'm not saying yes, I am calling for a recession. So let me just say that, but I will be open if things were improving, if the numbers were improving. I just don't see that. So how can we conclude soft landing? And especially if we just do a comparison to what the only soft landing we have ever seen, which in the mid 90s here, where we saw the Fed cutting rates, but we actually saw that the unemployment level were going down at that time. And we did not have a yield spread inversion. Now, every time we have had a yield inversion and we see a bottoming of the unemployment rate, well, then we actually see a recession setting in and we had a hard landing. What do we see now? We had the most massive yield inversion we have ever seen. We have yield unemployment moving up. What does that look most like? This situation or the situation we have over here? Again, looking at that, saying, what will I conclude is the most probable conclusion on this is that we have a hard landing. And if you look at the coincident economic activity index, which takes in 4 indicators here: non-farm payroll, The unemployment rate, average hours worked in manufacturing, and wages and salaries is actually, something you can just take out. You also see how that is declining, and we see that declining into recessions, declining into recession, declining into recessions. And even more so, if we do some momentum analysis on it, we see when it crosses down a level here on the RSI, we actually get a signal that has always been correct. We also have it here on the MAC. Let me see, it's the MACD. Yeah. So the MACD also. Why again would I conclude things are good? I cannot see that. Well, then some people will tell me, Henrik, you don't understand it because now the Fed will be jumping in with a lot of liquidity, and that's why they're going to save the day. Well, just remember, liquidity needs to start circulating in the real economy, else it's nothing. It needs to come into the hands of the average US consumer, the average Indian and Danish consumer, and we need to start spending that money. But then look at, if you've been facing inflation, you've been facing losing your job, and facing also interest rates spiking, and now you save a little more money on it. Will you then take that money and start spending it immediately? I say no. I think people will wait, and that's why you're going to see that there'll be a lag on when they start to cut rates, and we're going to see outright monetary stimulus till the effect actually comes. And by that time, the economy will be in a recession. So the Fed is very, very late. And actually here, if we look to the 2007 setup, we saw how liquidity was actually coming in. The Fed balance sheet was rising 30% in 2003. But what we also saw, because of the consumer struggling with interest payments, was that the unemployment rate starting to bottom out. And this is the real signal. This is what we should look for. The stock market is not what we should look for, because that tops out later. And even though people say, oh, it will actually front run the economy, it doesn't. The economy is the real economy, is the business cycle, and it's the consumers, and it's the unemployment rate. When that starts to bottoming out because of the consumer struggling, that is when we should start to be concerned. And yes, we know the Fed will start to cut rates like they did in 2007, but they did not prevent a recession, and we got the worst recession we have seen for a long, long time, and a financial crisis, and so on. The financial market, or the equity markets, they discovered it by October 8th, actually to late October for the NASDAQ in 2007. At that point, things had already been deteriorating for quite some time. I say we have that deterioration going on right now, and liquidity will not save the day short term. It will create a bounce at some point, but I think it's also going to create something much worse, which will be a stagflation coming out. So when I conclude based on all these things, I'll have to say, what is the most probable conclusion? Recession or soft landing? I say recession. I cannot see how we see soft landing in this. So what's next? Trust in soft landing is what I see is already having. I showed this in, I think it was in March of this year. Trust in soft landing is there. I think we're going to see euphoria, and I think we're going to see blow off top. And again, the blow off top is already developing. If you look at the S&P 500, hang on there, we have something of a pattern here, which is very interesting. I look at, pattern recognition, a pattern repetition. We see how here we have a move up in the S&P, which is called an expanding diagonal. At the same time, we have negative divergence, what it's called. And we have that on a weekly basis. That means that the momentum behind this top here was stronger than here, and it's stronger than anything we've seen up here. That means that, like a river, the strength, the current of the river is actually is waning. It's getting weaker. So, and normally, if you then look at it, we saw actually the Nikkei top, and I actually think the Nikkei has topped, and unfortunately, I think also the Nifty has topped, but let's get back to that. What we saw in 2007 was exactly that, waning, and we saw it again and again with the negative divergence. 1, 2, 5, 1, 2, 3, 4, 5. The top here was the top in the stock market in October. We also had a panic in August, and if you look at these two pictures here, I don't think it requires a lot of imagination to see that we actually have a similar setup. So I think we have a similar setup to 2007, and it's only a matter of how long and how far we can go with the S&P 500. I say 6,100 to 6,300. I think maybe 6,300 will be the situation where we're going, and it's going to be a massive blow off top, because the market capitalization of these levels, so the valuations, are through the roof. We have never seen the Buffett indicator, the GDP the market capitalization to GDP higher than it is today. It's higher than the major top we had in 2000. It was at 129 then. It's 200 now. In 2007, it was at 107%. It's 200% now. In 1929, it was at 107%. Everybody knew that was a major bubble. It's at 200 now. It's almost twice the size of 1929 and 2007. Just saying. And then we have all the weaknesses coming into the economy. So I say we're going to have a fall off like we saw in 2007, and it's the recession coming in, because that's what it's telling me. And if you look at what the Fed is doing also, they're starting to cut rates. Every time the Fed cut rates, it's not because the economy is thriving. They do that right before the market is topping, actually. So why would I think the economy is now deteriorating with the economy, the recession, sorry, the unemployment moving up? And we know that the personal interest payments are just through the roof. People are struggling, and the Fed is cutting rate. And I'm saying, oh, things are fine. I conclude the opposite. I say we're close to a market top. And I think we're close to a very big market top and a recession. Looking at the NASDAQ here, similar, I think we're going to go much higher. And I think the euphoria is going to build here, because my model here suggests we can go to 23,000 or maybe even 24,500 on the NASDAQ going into October and November. I think we'll have a major move after the presidential election in a 2 weeks time. And I think Bitcoin is going to do tremendously well. I think we're going to see October here. I still think we're going to see, I don't even know what it's up there right now, but I think we could go and see much, much higher levels coming into late of this month. So just a few days away. Above 75,000 could easily be seen, maybe 80,000 even. And I think we're going to have a blow off top in Bitcoin going into late November. I say we get 115,000 to 123,000. And then if we look at something way more important, obviously, with today's crowd, Nifty. And I was called out on Twitter and say, oh, Henrik, you said here that was top. I said it at this point here. I did not say top. I said there was a risk that it could have topped. And I say now that I think this is the top. This is the top in the Nifty we have seen here. If you look at this major move you have had in the Indian market, and you look at what we see in Nikkei, which also topped already in July and has not made new highs since. You look at the same actually set up also in Europe, starting to see the tops there, in Denmark as well. I think we have topped also. I think we're starting to see the deterioration first comes to the rest of the world before it comes to the US. And we all remember how into 2000 and 2007, especially us with the little gray hair, that people were saying, oh, but the US is going to pull us out of the crisis. And then we see the top in the US at a later stage than we saw in the rest of the markets. When the Nikkei tops, the Japanese market tops, 3 to 4 months later, we see normally for the last 3 recessions, we see that the US markets are topping. I think we see the same again. And the Nikkei top in July, which means that October or November could be a timeline for that, maybe December. So I think this is a very big thing. It moves up of a blow off top into a throw over into the structure again. Same with Nifty Bank here. I say this is a very, if we start to move lower from this point here, I would be very cautious about anything related also to the banking sector in India. Just like what I said also with US and in Japan as well and other places, I think the banking sector is starting to struggle, because when the consumers start to struggle, then banks are struggling. It's about what the consumers are doing, and we can see that they have a lot of unrealized losses in especially the US banking sector. And also in the Sensex here, I mean, I have to say, unfortunately, and maybe it was a good month we have this, I say this decline we see now here in October is not a good sign, because we had just a tiny throw over, and I'll be very, very cautious with what we see here now. Again, let's hope that things can be proven wrong, and they can prosper in the indices. But something that moves up like 231% since March of 2020, like 4.5 years, that's a lot. And these looks like this is not the normal act. This is not a normal move for a stock market. So I say, and again, if we look at it, we have a massive valuation bubble, at least in the US. I think that this is also the case in other countries. And when you look at gold, that's probably where people say, oh, but Henrik, you've been so wrong on that. And yes, I admit that I've been very, very early on it, and that's the same as being wrong. I still say, though, that when we get into a recession and a liquidity situation where the dollar is going to spike up to around 120, not now. Remember, I first had the dollar was come down, but I think it's going to spike into the deflation in early 25. I think gold is going to take a hit. So I think it's always a good thing for a long term. And I'm a major bull of gold, but just not yet. I think the spike we see right now, right here, is something we have seen before, and we will see that it's actually not even, giving us new high on the RSI, which will actually come down rather strongly before we see a new bottom, and that bottom will be a major buying opportunity. So if it's going to come down somewhat, well, it'll be for a certain amount of time. It will not take long, and then I think gold will soar, and I think gold can go to 5,000, 10,000, and much above that, because that will be what we see. But into the deflationary part of it, when dollar is strengthening, that is not a good safe place for gold. So I believe in gold long term. Next 6 to 9 months, I think I'll be more 12 months even maybe. We will have to be more careful. So now, finally, doesn't he ever end? Time for questions.
Thank you so much, Henrik. That was a very enlightening talk. And I'll be starting up with the questions without wasting much time. So we have first question from Mr. Sumit Kolgi. He's saying, Henrik, great to hear from you. How do you interpret the recent DXY move up? And could it put more pressure on crypto and IWM?
Actually, I think that the move we see up in Dixie right now here is a consequence of maybe capital moving out of other places around the world. So you actually see move into to the US. I do, however, see also that I think this is just a bounce that we've seen, and I think it's going to top out right around this level here. And I think we're going to see a move lower in the Dixie before it's going to have this parabolic rise. So I think it's, yes, short term here, it's not been good, but even though we had the Dixie moving up like this, we've seen Bitcoin being up in October, actually. So it's not like Bitcoin has taken much notice of that. Some notice. All coins is a different kind of. But yes, the moment we see the move that I think we're going to see from 95 to 120, which is a massive move, deflationary bust, I would not be in crypto. I will not be in much else than, actually being something that is the US dollar. That is going to be the king at that point, because it's the reserve currency, and most debt in the world is denominated in US dollars.
Right. Vikas Kumar is asking that Henrik, I think Henrik has already answered this question regarding the blow off top in Nifty, and probably this is the top. So that was his question. He said that you predicted a top before, but then I think Henrik clarified that he mentioned caution on Nifty at those levels. We have another question.
Weakness, correct.
Yeah.
But it showed some strength there, but it was but I'll say it was on borrowed time, unfortunately.
Yes, we have an anonymous attendee asking that, thank you for sharing your valuable information with us, requesting you to share your blow off top, stagflation and deflation levels in Nifty 50.
Yeah, so I honestly I think we actually gotten there. I mean, we are there. I mean, at least if we see more, I don't like the kind of weakness we have seen over the last few weeks here, and of course you'll not go in a straight line, and you will see a small bounce. Also, it's always like that.
Yeah.
And so I think, but be careful at this point here, because if the rest of the world falls into a recession, unfortunately, I'm seeing also India will do the same. And that's why the massive gains that you've seen is not something, it's not a trajectory that will just keep going. It's never like that. It's always where we feel the best is where we should be fearing the worst.
Yeah. Prat is asking that India has been performing relatively better than other major economies. How much do you think this US-led recession will affect Indian markets? How long do you think this recession is going to last?
I think it's going to be devastating also for India, unfortunately. I mean, India is also very heavily dependent on what's happening in the rest of the world. Of course, you have a huge inner market with a lot of people and consumers, but it is, when demand is falling in a global recession, you will see that in India as well. And that's where a lot of, and evaluation levels also will come down then. So I think, unfortunately, you'll see that India will also get affected by this. And lasting, how long it will last, I think the deflationary part this time around will be rather short. I think the Fed is going to pump money coming mid-late 2025. I think the Fed will realize how bad this actually is, and the deflation, which they fear, and they will pump money in like nothing we've ever seen. And the Fed and the rest of the world. And that will create a small bounce. But I actually see that we can see a stagflation unfolding. That is going to be the worst phase, meaning the economy will still be slowing, and the money that the monetary stimulus will not come into the real economy. So you'll create a bubble in financial, in commodities. I think you'll see a commodity boom. That's what I said also in the initial hypothesis, that you'll see a commodity boom, making, when oil is declining from where I see now, when we get that bottom, when we see or precious metals and so on, but the commodity boom going from, let's say, late 25 into 27, 8, 9. Well, I think that is going to send, commodity prices a lot higher, much, much higher.
Right. Prashant Singh is asking that, do you see precious metals going down as well during deflationary bust? I think, yeah, he said yes.
Yes, in the initial phase, but it's again on to the moment where we see the Fed is reacting. And I think it can honestly be a rather strong decline in precious metals, because the liquidity crisis this time around, I think, could be bigger than what we saw into financial crisis. And in that part in 2008, from March to September, you saw a decline of gold of 34%. And March to September, you saw actually silver dropping by 60%. And I think for silver and for gold, you'll see similar cases there.
Right. I come from families of gold and silver merchants. I think they'll be holding gold with both hands when they get that opportunity. Yeah, Indians are anyways very fond of gold and silver. Brad is asking, when Trump is elected and Elon begins to cut departments and government jobs are no longer added and the unemployment rate goes to 5, what do you see happening to the depth of the recession and timing?
Well, I think now we had a lot of assumptions into that, but I think that the depth of the recession, I mean, again, there are different kinds of crisis, and the deflationary part is one where we can stimulate ourselves out of. We can try to add monetary stimulus or fiscal stimulus, and that can work because the people then start to spend that money. But the problem is, if we get to a point where inflation moves up faster than we see the rounding in the economy, that is a problem. And I think that if we see that stimulus coming out, and I don't think it's just about Trump or Harris or whoever gets elected, this is in the cards already, as I see it. At least that's the indicator. I don't see any presidential candidate, making this a lot better all of a sudden. Well, then I think, it's going to be a bad crisis. Unfortunately, I think we're going to see one of the worst things we have seen since, as I said before, also 1929, because just the sheer size of the bubble is much bigger than what we've seen before, and the yield spread inversion that we have is massive, and it's just signaling something is wrong.
Right. Amit is asking, please share your views on gold and silver levels for upcoming years and your long-term view on these. Thank you.
Yeah, I'm not sure. I mean, I think silver can, as I said, I think I'll probably take it in percentages here. I think you'll see these kinds of declines, and you're going to see it setting in rather soon. Of course, as long as the gold, if Dixie is going to decline, as I say, there'll be some support. But we are seeing also gold having a very nice run now. I think silver can run a little more than this. I think it's 36, 38, but then I think you can look into a 60% decline from that level on. So be careful with precious metals into the deflationary bust. After, I'm all with the engines there on buying gold, I can promise you.
Right. Arvind is saying that since most influencers and media are saying Bitcoin will blow off top to over 100K, I disagree on the narrative. I personally believe that it will top out in 80s from 50s. In this period, there should be a massive alt season. Can you share your thoughts on this, please?
I think we are actually setting up for a very big move in Bitcoin. Actually, I think when we've been seeing what is called a kind of a flag moving since a March high, and then we're seeing going down, but in a very correctional way. You don't dress up in a tuxedo only to go to the pizza joint. I mean, so when Bitcoin is making that big of a correctional move and it's blowing above that trend line, which is around 69, 60, 70 or something like that, 70K, well, then I think we're going to have a bigger move. Then 80 would be like, as I said, putting in a tuxedo, and then you just go to the pizza joint. You're going to a big party if you put on a tuxedo like that and taking that long time for consolidating. So Bitcoin, I think, is above the 100, I think. 115 to 123 is my target.
Amit Sura is saying, what about US $1 trillion debt, $36 trillion, and US dollar may not be the major currency? Your views on BRICS?
Yeah, so I think absolutely there's a momentum on that. I think the BRICS are too different in terms of their what they want in the world to actually being able to align that. But obviously, I mean the dollar hegemony can be under pressure at some point. It's not under pressure into deflationary bust where the whole world or all the debt in the world is denominated in dollars. That will require that will put a demand for dollars. If we get into an stagflationary world, well, then I think the dollar can come under more pressure. But for now, as we look at it, as we just talked about the strength in it, it's very strong. And when they started to print money in 2008, or it's not like we actually seen a very long but upward moving pattern since that time. So I think the narrative is front running something here, which is not really developing at this point. I think the dollar strength is here to stay for a certain amount of time. Will it be here forever? No, I don't think so. Will it be the BRICS or something else? I think we're going to see something of a monetary a reset at some point where you will see a new world currency coming out, but that's a few years down the road.
Vishnu is asking why the US market is not behaving the way it should be after the Fed rate cut, and when are we potentially seeing the blow off in the US markets?
I mean, I think they are actually moving as they supposed to. I think we are seeing that the markets are now moving higher. I think there's a lot of they have been pushing up. As we see actually, if you look at it, then you can see that the inclination we have in the market is actually going up quite nicely. There have been some setbacks, but the rate cuts is a signal to me, as I showed before, that we are coming to an end of it, because the Fed is starting to see the deterioration. They don't want to be too vocal about it, because if they say, oh shoot, things are bad here, then they know people will be withdrawing everything, and that's not what they want. So I think the rate cuts now are showing people that, oh, now liquidity can come in. We have financial conditions that are now comparable to what we had in November of 2020. So for now, things are good, but only until the moment where we see the real economy catching up. And I think that's when the initial claims do the spiking. That's when I think that's the canary in the coal mine.
Right. Mr. Ramesh Chandra Tiwari is saying that, is it recession will have least effect on Indian economy? Name the country which will suffer maximum due to recession and how you calculate percentages of recession. That's a difficult one.
Wow, that's big. I can't say that, but obviously I would say that I think I can't speak too much of the Indian economy there. I simply do not know enough. I will say though, and that the European economy, where we have countries and we have the euro, where there will be certain countries that will be performing better than others, and we don't have a common fiscal policy across the eurozone. That is a big problem for us here. So we will actually see that some countries will be very badly hit and others will not be. So there will be what do you call that, out of sync kind of reaction needed in Germany compared to needed in Greece and other places. So I think some of those that can suffer the most could be actually places in Europe. I think Europe can be hit really hard by this.
Yeah. I would like to say that, the kind of narrative that is being created in the newspapers, in the media, and the TV channels, it's like, that this is India is glorified and Indian economy won't be hit by recession. I think that's the narrative, and only time will tell us that where we are heading to in the coming years. So let's see. Prashant is asking that, can you please tell your views on China liquidity injection, and can US economy enter deflationary phase while Chinese economy starts recovering?
Oh yeah, absolutely. You can see that. I mean, and I don't think this Chinese economy is recovering. Let's just be clear about that. I think that what you see now is exactly the kind of fallout, the effect you would see, that the money is now soaring into some certain assets and creating this initial spike. And I have actually forecasted that I'm actually saying that there will be a huge spike in China because of the technical setup and in the Hang Seng, and we're seeing that. And I think it will continue for a month or 2 months or something like that. But then the things is that you cannot solve structural problems, solvency problems with liquidity. This is the problem that people are thinking, oh, you can just throw money at it. But let's just be clear about that. If it was so simple, I mean, then Germany, Weimar Germany would have done much better. If you can just print money and you save all structural problems, it's not like that. And actually, I think down the road that doing this, trying to do this, is going to create much, much bigger problem, which will be what is the Minsky problem situation, where you simply have valuations are at perfection. And when you then have a slight rise in the interest rates, then everything collapses. So I don't see, liquidity will not save the day. It's simply it needs to come into the real economy, and the real economy is suffering right now. So China will decline, and I think China has a huge problem because they have been building up a lot of capacity in the real estate sector, and a lot of wealth has been coming out from that. And if that starts to deteriorate, and it already is, that is hurting real people on their consumption, hurting the real economy in China. And it doesn't matter if it's more planned, economy, it will still hurt people if they see their values of their homes coming down and the vast excess capacity they have in the real estate market.
Right. Hemal is saying, brilliant, Henrik, as always. My question is that in question 2, you called for 24,100 blow off top in Nifty coinciding with Nikkei. Nifty has already exceeded by 10%, 26,300 in October. What could be the watershed level for Nifty now based on your analysis?
So the watershed in terms of declining, or what do you think? What was that?
I think so.
I think, as I said, I think we always have an initial decline and then it comes back up. And I can promise you at that point, a lot of the audience here will think, oh, Henrik there was wrong. It was just a small decline, and then it comes back up. Actually, that is the feeling we always see when we see the first decline, and then it bounces up and people say, oh, now we're going back again to things. It can be into early 2025. We can see into Q1, maybe things are bouncing a bit again if we get the initial sell-off phase, or it can be a little later. But the watershed moment will be more of when we see that small bounce and then things are starting to unfold. I think Japan is closer to that because their top was in July. So I would not, and please note this, think that Japan would start to show the way also. And we in November, actually, some of the reason why we could see some of the fallouts could be the continuation of what we saw in August. Actually, in 2007, we had the subprime crisis actually being a problem in August 2007. Then everybody forgot about it into the October high, and then boom, it all of a sudden became a problem. I think we're seeing that same, but just with a much bigger scale, which could be Japan as a trigger.
Right. Hemal is saying that US unemployment and DXY are showing some resilience for last few weeks. Does it change anything in your analysis apart from delaying of the blow off top?
No, it does not. And I think, the unemployment rate is good that we get good numbers now, because that is actually fueling the soft landing narrative. So we see everybody's now, oh, but Henrik's wrong because it's, we see the nice number today on the initial claim. So not too bad. Actually, what we see is that the deterioration down beneath that, the continuing jobless claims are still rising. And again, I think this about when it starts to shed jobs, I think we need to come after the election now to see that you're getting some confirmation in one direction or the other. But still, there's no confirmation in what I see with the Dixie more than that has been a bounce. And I think when that bounce now is starting to move down, it will support the risk on rally for some time. And then we see the real unfolding into, it may top again, and we may see the top here in November, December, but the real fallouts of this will be into next year.
Right. Henrik, we have 50 odd questions. Just let me know whenever you want to finish.
No, but let's go on. It's okay.
Perfect. So Mr. Ajay Natarajan is saying that when do you see the deflationary bust hitting Q1 2025? And how much do you see the S&P 500 falling in this deflationary bust ballpark?
Okay, yeah, that's again on top of my head here. So I think the moment when the deflationary bust is setting in, it will be the point where we see the dollar bottoming out. So just like in 2007, what we saw there was actually that the Dixie was declining into, first there was a bottom in around October, then it bounced a bit, and then we saw another decline into March of 2008. That was the time of when we start to see what I call the deflationary part. That is when we start to see the black swan events, because things are now starting to deteriorate. I think we may see the same here, that when the dollar starts to rise, and actually we had the Bear Stearns situation in March of 2008. That is the deflationary. So the moment the dollar reaches the level that I see, 95 to 97, which is going to be a big push to the risk assets, well, then I think from that moment on, and when it starts to rise the next time, will be the start of the deflationary bust. And that can cause the S&P to fall to, let me see, I think the first stop, and that will be the deflationary part, actually will be around the bottom we had in October 22.
Right.
That's the first stop.
Right. Harpreet is asking that how to be ready for recession in Indian context.
Oh, that's difficult, right? It's so many
Yeah.
variables there I can't say, but I think exposure. I mean, gold will not save you in the deflationary part, but if you hold on to it, the reaction from the Fed and from everybody around the world will be, let's print money, and if they create inflation and stagflation, then gold will do fantastic. So if you can accept a 30, 40, 50% decline in gold, and you hold on to it, and you say,
Right.
yeah, then I think you'll be fine, because gold will help you then on the next path. But you will
Yeah.
see some headwinds there, I think. And then the exposure, if you need to pay your bills, or you need to, then US dollars is always a good thing into a deflationary phase, and
Yeah.
potentially treasuries. But there are no recommendations here, guys, because I don't know any of your private risk profiles.
Right. As far as Indian context is concerned, Henrik, let me tell you that Indians won't sell off gold very easily unless it's really necessary. And we do have a habit of saving a lot of money. Like we really we are not spendthrift people. We really spend, like if we are earning 2 rupees, we'll be spending 50p. So we are used to living miserly. So I think from Indian point of view, I think very few people would be selling gold. But yes, in that deflationary phase, they would be really hoarding up gold like anything. So I think, yeah, we should be able to do that. Fingers crossed.
Sounds like a healthy financial culture of people of India to actually save money, because that's not what the rest of the world they go. They just
So
spend. Mhm.
So for the old-fashioned people, but as we are seeing in the new generation, people are really getting addicted to options and futures. And as you must be knowing that, Indian market is the biggest market for the options right now, even beating the US numbers. So I think for the new generation, they might be struggling really badly, who have in and out equity exposure. And the gold and silver thing was more of a traditional cultural way of keeping yourself safe for the rains. Yeah. So Mr. Ajay Natarajan is asking that, does employment rate go into double digits in 2025
Unemployment rate.
deflationary bust?
I think it will. I think it will.
Right.
I cannot see this as a soft recession. So I think it will, and I don't hope it, but there's just so many. And if you look at this, I said the structural unemployment, the average weeks of people being unemployed is moving up from a very high level already. So I think, yes, unemployment is going to spike much higher.
Piyush is saying, seems it will take longer than what is being predicted. So far, there is no pink slips.
Again, I'll dare and ask, how many actually did see the top in 2007 in October and November, even December? I mean, even Fed Bernanke was out in February, in two months into the recession, and saying no recession here. So I think that maybe people are just front running it a bit. For as long as the markets are moving up, I'm with you, and I'm also bullish right now. I say I'm extremely bullish, and I'm extremely bullish crypto and all that. But I think we should be careful about saying, oh, things will just be postponed, because we have all the indications that are there now, and at some point we see the watershed moment in the economy, and then it may be too late. So it's about the structures that I see with the technical setup on the S&P and so on, that is telling us there is an end date to it, and it may be coming in November. I will be adjusting I mean, for me, it's not about calling it the date for it. It's about calling the levels. And the level has been, I called it in October 2022, I said 5,700 to 6,000 was my call back then. I have now adjusted it to 61 to 6,300 on the S&P, and I maintain that. So when we get to those levels, I will start to be cautious, and especially now when I start to see some fallouts in, at least in Nikkei and the Nifty and the Denmark and all this. Not that Denmark is a big thing, but we are a small open economy, which means that we are more exposed also to the bad weather that is coming, and we may be topping out earlier. And I think we're starting to see that. So I would be careful saying that the things are not there. And what is it again? Really, we base that on? Is that the evidence that I've provided today, or what is the piece of evidence saying, oh, things are just going to go on?
Right. Hitesh is saying that one major thing missing compared to 2007 is leverage in the financial system. In 2007, leverage amplified the fall as many financial institutions failed. This amplified recession too. But in 2024, the bank balance sheets are much better and adequately capitalized. Don't you think then that the intensity of recession or fall may not be as severe?
First of all, we have a much bigger bubble this time around. And I have to say, most of the crypto market is a bubble. First of all. Second of all, you have the valuations of the stock market, as I said, is twice the size of the valuation level as per GDP than it was in 2007. So that is a massive bubble. So if these are, and we also, if you look at the unrealized losses right now in the banks, they are 10 times higher or even more than that than what we had in 2008. So I'm not really sure that I see that. I see that we do not have the same kind of crisis, and we never have. It's not like the history repeats exactly. History rhymes, and I think we're going to see that we have now a lot of other exposures. We have a lot of private equity funds around the world, which have also been saying, okay, yields are so low, so all the partners of these funds are saying, find me yield I got a lot of money here, I want to put it into the private equity fund, and they have been speculating in all these different kind of businesses that do not really show the value, that have not really made money. I think you're going to see it elsewhere. The commercial real estate is also not looking good. So there are plenty of places where we can look for this. And I think again, we should not look into the same kind of places where we'll see the pain, but similar kinds of places.
So, one anonymous question that once your blow-off top levels are achieved, Henrik, will you sit on cash and do nothing?
So when I actually no, I will not. I have a more aggressive situation. Aggressive positioning that I want to do, which probably will be something with options and making myself an insurance there. There will be something about being in cash, yes, but that will be in dollars, so being very long the dollar. And there will also be something about bonds, because I think the yields were going to plummet, but I will know that there is a limited time for that, because I think when we see Druckenmiller and all these guys now coming in and saying we think inflation is going to pick up, I think they are too early. They are too early, because we need to see first the bust and the yields coming down. But and that time will actually be good for bonds, but it will be a limited time, because I think yes, inflation will come later on in the stagflationary environment. So it will be a very difficult environment to invest into. There will be whipsaws. What is good one day will 3 weeks later not to be good, and that will create a very difficult environment.
When do you expect, in which year you would be seeing the bottom? 2029, 2030?
Oh, no, I don't think we get out that far. It'll be
Okay.
more that we see a very fast move in the deflationary phase, and then we see a bounce for 6 months or something, and then we see, I mean, I think 26 again can be bad, at least the last part of the year also. So it's difficult to say right now, and I rather say we can reconvene here in a year's time. Let's see, then we can talk about that.
Yeah. Hitesh is saying, although US banks do have MTM losses on bonds, but they are not being reported on P&L, and they get realized only upon bond maturing. Until then, Fed would come up with some new gimmick. So do you really think this is going to have any impact?
So again, first of all, this is correct. There's something on it, and it's a mark to market, valuation. If you do that and you have but we also know that when you have something that is so structurally unsound, something may come and challenge the situation. And again, if the Fed could just print money and the rest of why don't we just print money every day then? Why don't we just continue? I mean, let's just print money. Then it's not a problem. But that's not the way that you cannot solve an economy like that. This is where we have been led to believe that we cannot do that. If we lived in 1980s right now, in 1882, we would be pulling our hair out and saying, oh, how could we even think about what we're doing right now? Then we have been 40 years later, we're now thinking modern monetary theory, but which by the end of the day is really about depressing the yield levels, because then we can get more money into the system, and then we should get a trickle-down effect. But the trickle-down effect is based on the US, on the consumer. If the consumer does not start to spend that money, it's all worthless. Not worthless, but it will not have the big effect. And that's what we have seen also when the Fed comes in and try to do these saves. Yes, it may save it a little, but it's about the consumer deteriorating. It's not about the banks only. It's about the consumer now starting maybe to lose their jobs as well. So I think it's a bigger picture, and it's more, should be more directed to the consumer than it is about the financial world. The financial world is not the main thing that we should focus on. We should focus on real live people. What do? They have a job and they have a house. What is happening to that? And that is where the economy will go.
Vijay is asking, thanks for the wonderful presentation. If, as you say, India moves with the US on the downside, then is it not logical to expect Nifty also to make a new all-time high, since you expect S&P 500 to go above 6,300 levels?
No, because I think you'll start to see that when we have, again, it's people moving their money into certain into investments. And if you're looking at it right now, would you rather be in the if there's starting to be some uncertainties in the US or in Denmark, for instance, let's say, I mean, then people start to say, well, the US looks, more looks like a better bet right now because we have, good earnings there. It's the top part of the US, and I think some of the speculative assets can also do well. But we see that again and again. Money moves out from the rest of the world. The rest of the world tops out. Even the Nikkei, I mean, the Japanese economy is also a major economy, and they topped out 4 months before in the financial crisis. And we have seen that again now. That money, some money that people are pulling out, will start to flow into the US for a certain amount of time. And then we see this kind of development. So I think we're seeing the rotation will rotate into US as a final part of it, and maybe even to more speculative assets, and as we move into the final phase. So I mean, everything, it has an end but in the US markets, but it's just the last end. It's the last man standing. That's what we normally see.
Right. Rohan Era is saying that, Henrik, do you see your favorite alts, Jasmine and WIF, rally and meet your targets of $77 for WIF and $0.32 for Jasmine in line with BTC? Or do they rally after Bitcoin tops sometime this year, indicating capital flows into alts in Q1 of 2025?
No, again, alts is a very, very, dangerous game. It is. I mean, I know what I'm in, and I know I can, lose that money, and I know my risk profile there. So please, make your own risk profile and an analysis assessment there. But yes, I see it because I think that when we have the blow off top will be created by sentiment. That's what I started to say about sentiment, that the US economy will pull us out of the recession. There's no deterioration. We don't, I mean, the labor market is strong. The Fed is behind us, and Harris, Trump, whoever you prefer, will get elected, and then things are fine. But so I think that you will see that rotation from a lot of capital coming into the US, and you will see then the dollar declining actually because of also that the Fed will start to signal that they will do further rate cuts, and then you will have a euphoria. So it's not about, this is not fundamental value or of any sign. This is actually about the blow off top where greed comes in, where animal spirit comes in. And that is what I think will drive this last phase here. It's not right now at these levels here. We're not talking about anything that is a fundamental analysis. And I think, yes, I can see those levels, but I could also see a situation where I could be wrong. So please make your own assessment of that.
Mr. Jaspreet is asking, I need to know what are the levels of bottom and time in Nifty and Bank Nifty.
If one more time, sorry.
He wants to know that what do you think could be the bottom levels for Nifty and Bank Nifty?
Oh, again, when something goes up like this, and you see the Sensex, you can just look into history and then see how many times do you see something rise by 230% in 4.5 years, and what will the declines of those be? Will it be half of it? Will it be more? I think you can see some very strong declines in some of these markets, and I don't want to come up with some numbers here because some of it may sound ridiculous. And that's, I can tell you again, 5,700 to 6,000 sounded ridiculous in 2022. It's just 2.5 years ago, and now we are here. So when I say we have one of the most serious crises, or economic crisis coming against us, I think that if you have seen a bubble in some markets, you probably could see a lot of that air coming out. So just defining it right now and saying this is where we go to. I have some levels, but I'd rather say, again, let's reconvene in 1 year. We can look at levels.
Yeah, maybe next Diwali in 2025, we can
Would be
have our
nice to,
meeting
yeah.
again and see that where are
Yeah.
we after this webinar. I think we have pulled up most of the questions in one way or the other, and I think it's time to
Rakesh,
conclude.
Srishti, Rakesh is asking, are the markets being kept up due to the elections in United States?
Yeah.
Yeah, I mean, I'm normally not one who, first of all, I'm apolitical. This is not what I'm focusing on. And I don't want, this kind of argumentation first of that one or the other will create a better market. I don't, that's not how I do my analysis, and that's not how I see it. But what I do see is that it's strange to see that there are some very high numbers on the governmental side actually being, people being employed in, as I said, if you look at that down below the NFP numbers, we had, huge number of people coming in on the governmental sector, many times higher. So are we seeing actually the job numbers are being artificially high? There is, when you are 3 to 4 standard deviations away from what we have seen previously,
I
there
think we
is
might
something.
expect some revisions coming on later.
Exactly. Yes, I do so too. I do so too. So I think the job numbers are being kept up. They cannot keep the markets up, but they can keep the job numbers up.
Same is happening in our country. We have the result season coming in, and we recently got the commentary from one of our top market cap companies like Nestle, HUL, that the consumer is struggling and the share prices are dropping like anything after the results. But at the same time, our GDP is very good. So I think, yeah, the elections and many things. Let's not go politically out there. But yeah, I think we are getting the vibe what we both mean to say.
There is one question by William Berg.
Yes.
Is there a possibility that Standard and Poor has already topped before it is able to reach 6,000, since everybody is calling for that?
Oh, everybody's calling for that now. Yeah, I saw that Goldman Sachs actually moved their target up to mine now, so I appreciate that. Thanks to Goldman Sachs. They're just a little late, but maybe they subscribe. I don't know. But anyway, I don't think we have seen the top there yet. I actually do see, and that we saw the top in I think it was October 2007, in 8th of October in the S&P, and we saw the Nasdaq continuing up. I think there's more momentum up to the upside here. And again, also because we haven't seen the deterioration in the economy to that point we saw back then. But if you look at the market yields and so on, the 2-year yields, we are actually seeing the same kind of developments. So, and we also moved 15%. Actually, we moved from the bottom in August 2007 to the top in October. We moved 15%, 15.5%. We actually just moved 15.5% also to this. I'm just saying that it's a very clever question here. I don't think we're at the top. I actually do think we're going to get to the 6,000 level. There are too many structural FIP levels that tells me we're going higher, and I would like to see 6,100. But at that point, I would be more cautious on what we could see. And also, normally, after the presidential election, we see a very good market for the few days, few weeks actually. So I think we're going to see that again. And but come that time, 2-3 weeks after the presidential election, I would be careful.
Right. Mr. Vijay had asked a question on BRICS currency. I'm unable to find this question. He also said, and finally, on a lighter note, have you filed a defamation suit against your Betanoyer, David the Contrarian, as you threatened him recently? Incidentally, both of your views are similar.
I think it's quite interesting. I mean, I'm an open guy. I would like, and people can see my analysis quite open and frank. I just encourage that if you can do the same, we could actually compare. Wouldn't it be fantastic to see how you can get to the same levels from 2 different angles instead of saying you copy me? And again, I'm not sure I've ever seen him copying. First of all, I'm actually not sure of his targets. I'm blocked from him, so I'm not sure what his targets are. Mine is 6,300, 100 to 300. What I've heard from others is that his has higher. So I don't think we were on the same boat. So does he own actually that we are in a bull market? Sounds strange. Does he actually have views on Bitcoin, on Ethereum, and all these things here that I haven't? I don't know. I haven't seen it. So why do they come? So I stole one where we don't have the same targets. And I mean, come on. So I think it's a little too crazy here, and owning a call is a little crazy. What we do is that we, of course, are getting inspired by one another. I will not, and I always refer to the people that I get inspired from. You saw some of the charts today, Game of Trades and others. I get inspired from that as well. Of course, that's what we do. But to say that you stole my outlook, come on. And no, I have not done that. But I'm honestly, I mean, at one point, there was a guy saying to me, "Why don't you do that?" I mean, it's causing you. Now I think it's simply just becoming ridiculous. I mean, it's that you're almost creating a crowd, standing there with your pitchforks and saying, "Oh, you stole my outlook." I mean, come on.
Twitter is that place. I think sometimes in capital letters, IGNORE is the only solution. So,
Yeah.
and maybe things get fizzed out with time.
Yeah.
Rakesh is asking, do you agree Bitcoin prices are surrogate marker of liquidity?
Yeah, it's an indicator of liquidity. Yes, yes. On financial conditions, yes, and even some more so. What do you call that? Altcoins. Yes, it is absolutely. So that's why when you start to see Bitcoin and altcoins do well, that it's because of liquidity, and hence also if we get into a liquidity crisis where liquidity will be flowing out because of large losses in the financial sector or in amongst wherever we can see it, well, then you will have problems with being crypto. Then it's not like, oh, I just jumped to Bitcoin or to crypto because that will thrive. No, because people will be forced to sell it off to get what is the real money, which is US dollars, and that's what you can
Right.
pay off your debt with. So I don't see that, it will be the safe haven. I actually think people will be fooled into believing that, and then
Yeah.
you can have a problem.
And where do you see the bottom of Bitcoin?
Again, this is one of the questions where I'll be carried out on, and burned on the fire, because I actually can see a very, very low level, and I do that because of the structural setup, and I think that if my outlook of a stagflation is coming, then the central banks of the world will do one thing. They will say, hey, we do not want money to run outside of the economy to create inflation that way. So
Close
we need
Bitcoin.
to come down hard on crypto and Bitcoin. And in that world, people say, yeah, but that's what, the Bitcoin will stand outside of that. I'm just saying, well, they have also at one point put people in jail for holding gold. So do you think honestly that they cannot
Yeah.
prevent that if they wanted to? So
Yeah.
I'm just saying, I would like to see what Bitcoin becomes after the stagflation, and if we see a monetary reset of some sort. And we know that the central banks of the Fed and the ECB are, at least, and maybe other central banks, are working on a digital solution. Do they actually want competition to that, or do they want to do something about it? So, and so I think people need to take that into consideration as well. So the bottom in Bitcoin can be very, very low. And I think it's 20 years down the road, I think we will be looking at the whole crypto thing and saying, like what we did many times into new technologies coming out. The blockchain technology is a new technology, but every time we have new technologies, we'll see that people are saying, oh, this, and then you have a huge amount of speculation around that. I think that's the speculation we see right now.
Yeah, yeah. Ajay is asking, I remember you mentioning that this recession will be the worst one since 1929 in the US. Does that view still hold true? Bigger than 2008?
Yes, it does, because the bubble is so much bigger, and I think we have at that point we actually had an opportunity to do quantitative easing, or printing money, or suppressing yields. If we do that today, and we do see the stagflationary development that I think we could potentially see, then you will see that not the deflationary bust will not be bigger, but the stagflationary phase will be much worse. And stagflation are worse than deflation, because this deflation you can actually stop. You can just print money and then you'll stop it. And that's just a matter of when the central banks jump in and they start to do that in a certain amount of way. But that will not save the day if I'm right that we get a stagflationary phase. And the stagflationary phase is not something you can stop. You cannot print your way out of it. You're not stimulus. You cannot stimulate. You cannot. The only way you can do is do something structural about it. That's why I'm saying I don't think the first phase, before we actually get a long bounce, 6-month bounce or something, but the second phase of it, of the big decline I'm going to see, that I see, will be the worst case and the worst phase, and that part. And if you accumulate the decline from the tops we're seeing these days here to the bottom of it, yes, then I think we're going to compare that to more than what we saw in the 2008. And remember also, NASDAQ did only take a 55% hit in NASDAQ in the financial crisis. They actually took an 85% hit in the .com. And this time around, actually, in terms of the valuation levels, are more like the dot-com crisis and the technology sector focus than it is the financial crisis. There are similarities to. I think we have a combination of the financial crisis and the dot-com crisis. So yes, I think we are going to see a very bad recession and lasting longer than we normally see. It doesn't just take a year, 12, 14 months. It will take 2 years or longer.
Every recession has a poster boy. I think this time is it Nvidia?
Yeah. Oh, yeah. Absolutely. Yeah.
Ajay
Don't
is
mention it.
also Ajay is asking, outside of the commodities in the US, any good markets to invest post this deflationary bust or sectors?
I'm not investing into a deflationary bust, because when liquidity becomes shorter, I mean, it's like going out for a swim somewhere, and the water is pulling away. I mean, then you'll be lying there, in the water. There'll be nowhere to swim. I think when the deflationary bust is coming, that it's not the time to be. That is about preservation of capital. It's about staying safe with what you got, and 0% will be a fantastic return for 6 to 9 months. But actually understanding that is something you need to take in and say, maybe it's just good that I just keep what I have, and then getting ready for the next phase. And that is more of the when the Fed comes in, what is then the next thing? So I would not, again, there are the dollars, staying long, maybe treasuries and so on. But again, you need to know when and how to get out, because both of these will have a bad time in stagflation.
Yeah. Bernard is asking, in 2008, the yen was even stronger than the US dollar. Do you think the JPY will outperform the US dollar during the rally to 120 in DXY?
No, because I think that the yen is going to get crushed. And actually, I think when I have some outlooks on the yen, it seems like we can see very high levels. If we all remember, since the 70s, we have seen the yen, how it's been appreciating against the dollar for a long, long time. And I think what we see now is going to be some kind of a give back of that. We've seen already it move up quite a lot, and we're starting to see that that deterioration of the yen as a problem for Japan. I think actually that can be one of the big fallouts here, is that we're going to see a weaker yen versus the dollar, and that's why at some point the Fed will have to jump in. This is not now. This is when they come in and try to fight deflation, that we are seeing that they will try to crush the dollar, deliberately against the yen and against other currencies to create growth, because the dollar moving up is not good for the world. If I'm right on the 120 on Dixie, it's going to be crushing across the world.
Right. Ankit is asking, the second stage of yen carry trade, will that happen?
Yeah, I think the yen carry trade, I think, again, I think that's a narrative following the development. I think yen carry trade is something that the media like to talk about, and that is actually more of a symptom than it's the case. What is the underlying thing? The underlying thing is that you have Japan, where you've been crushing yields for so long that when you do a valuation of a certain asset, you look at what is the cash flow I can get out from it, and then what can I get in safe yield somewhere. And if you do that for a long time, you'll see that valuations becomes exceptional if the valuations are going to zero. So if you have low yield levels, you'll see valuations are coming up, which is good. But the problem at one point, which is also what Keynes were refusing to answer, actually, when he was asked, when you get to a certain level and you're doing the stimulus for a long time and yields are at lows, what do you do then? And then he said, well, in the long run, we're all dead. And that is actually the thing we see in the Japan now. I think the small rise and spike in the yield were enough for valuations to crumble and for banks to realize, oh, shoot, we have losses here. That's why you saw the financial sector just going down 25% on the day. That has not come to an end yet. So I think that the carry trade is what people are trying to explain it with. That's a symptom of something of a bigger problem.
Right. Bernard is asking, do you have a VIX spike target for early mid 2025?
Oh yeah, I would love that with options called, right? I would only say that if you look at the VIX, how it went up into the financial crisis, I think it went up to around 89, 90 or something like that. Then you saw into the Corona, again, from the top of my head here, I think we saw during the Corona crisis, we saw it going up to around 85, almost hitting that. So what did we see here in August? We actually saw this VIX spiking to 65. in a 1 day kind of thing, 2 day thing. It was a nothing burger for the rest of the world. It was Japan. So would I expect the VIX to top out above 65? Yeah. Would I expect it to top up above the Corona crisis? Yes. And would I be, with what we've seen here now, also think it's starting to top out above the financial crisis? Yeah, the level from that. Yes, I do. I think we're going to have a huge VIX spike, and I think that will be a fallout. The fallout, the black swans, is not what creates the recession. The recession sets in, it starts to deteriorate the economy, and then you see actually that things are starting to deteriorate in the banking sector, and banks are then having problems. That is, we're not there yet, but we could be getting closer to that. And if we see those fallouts in 25, yes, then I think you can have a VIX that can spike above 90.
Right. Ranjit is asking, is it time to sell large cap stocks in India, or we will have another final push to the top before the crash?
I'll refrain from answering that question because I don't want to, that's only one thing that is worse than losing your own money. That's, helping
Yeah.
others lose their money. So I don't want to say that if it's the right time. I just want to say, look at the things that we talked about today and then say, well, there are some times that 0% is actually a good return. And is that now, or am I trying to time it perfectly to perfection? Nobody times it to perfection, but it's about taking chips off the table like Warren Buffett does. Why does he take chips off the table? Why is he so long cash right now? We can just wonder, has he done well in life? I think he has. He's one of my, favorites, or one of my idols there. So I think that when he does that and it, aligns with what I also see, then I think, oh, wow, maybe what he does is not too stupid. So I'd rather, look at him and then do, similar things of what he does.
From an Indian perspective, I would just add to whatever you said, Henrik, that 0% can be the best return sometimes, and saving your capital can be the best return sometimes. And having an equity exposure which doesn't trouble you and you are happy to lose it, saying like, okay, I had spent a good money in casino and I'm fine with that. I think that should be it. I mean, and again, it's a very individual perspective. Like
It is
last
absolutely.
year in October, we were like, oh my God, the recession indicators are on. And then the markets really went boom, boom, boom up. People were like, Srishti, you're such a big fool. You're saying recession. See, we have earned so much. And, so you can never advise anyone. All you can do is make your own decisions with which you can be happy with.
Yeah, exactly. Agreed.
Yeah. I think we'll conclude. Purvish, sir, I would like to have a concluding remark from your side.
Oh my God. I think we are just flooded with questions because the
Yes,
entire
I'm
webinar was
struggling marking them.
exceedingly interesting. If we could, we would give Henrik a standing ovation. This is
Yes.
fantastic, and I think we are just waiting with our bated breaths to have you again sometime, maybe early next year, to have a
I
follow
would
up on
love to.
whatever we have discussed here. Thank you very much, Henrik. This has been
Thank you very much.
absolutely, you hit the ball out of the ballpark. Great. Thank you
Thank
very
you
much.
very much.
Thank you
Thank
so
you.
much, Henrik. We'll conclude our session. And for those who could not attend tonight, we'll be having the video recording uploaded on YouTube very soon. And I'll be sharing on Twitter as well. Thank you, everyone. Thank you so much, Henrik. Thank you.
Thank you. Have a nice day wherever you are.